Hello, everyone. Today on the final bar, my guest is Rick Bensignor from In the Know Trader. It's funny, as we're getting ready to prepare for the show, the market accelerates to the downside. You know, not necessarily a technical pattern that we saw today. There's news out of California that they'll start potentially reclosing and dialing things down, but it's certainly causing a lot of pressure. A lot of charts that sort of looked pretty good turned into kind of good and now look very distributive. So I have to see what this means for the long-term trends. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller, here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to try to make sense of these markets. And days like today, I scratch my head a bit in terms of the futility of what we are trying to do in terms of trying to understand these markets. But again, days like today remind me of the value of thinking about the long term, the value of looking at charts, because regardless of what causes these movements, these fluctuations on the charts will tell you what is happening. That will tell you when there's panic, when there's excitement, when there's euphoria, when there's desperation. All of that's going to be reflected on the charts. So what we'll try to do today is try to make sense of these things together, look at the distribution we saw into the close, what that means from a technical perspective. And again, hopefully what you were able to do is combine what we talk about here with all the other inputs that you're looking at, fundamental data, money management approaches, news flow, all of that, as well as earnings, where we're clearly in the middle of it. Now, coming up today, we have Rick Bensignor joining us from In the Know Trader. I'm excited to hear what Rick has to say about these markets where he's at. This is the beginning of our entire week on StockCharts TV called Charting the Second Half. We've been planning this for months, and we're so excited that it's here for you. On my show every week, or every day this week, we're going to have a different guest whose main presentation is going to be coming up in the next day. So Rick is actually giving a full presentation on his second half of the year outlook tomorrow at 10 a.m. On StockCharts TV. Joining me tomorrow is Tony Dwyer. On Wednesday, Chris Shavako from Shavako Capital Management. On Thursday, Mary Ellen McGonigal from the Mem Edge. All of them will be giving a full presentation later in the week, so their appearance on my show is going to give you just a taste of what they have in store for you. Also, as a reminder, this Saturday morning, 9 a.m. Pacific, 12 p.m. Eastern is going to be our Market Outlook panel. I'm going to be moderating a discussion with 4 StockCharts contributors, really understanding what they are seeing and what they're thinking about for the second half of the year. So if you ride with us along this journey this week, you're going to get a lot of really good insights and hopefully very good ideas about what to do next in your portfolios. Let's continue on to our market recap. Again, as usual on Monday, but especially today, my cup runneth over with things to potentially go through. So we're going to try to hit on as many different ideas as we can. I did want to start off, though, with a poll. One of the things we asked you recently on StockCharts TV was, which of these events do you see happening first in 2020? Your choices were the S&P breaks to new highs. That would be S&P greater than 3,400. S&P breaks below the March low, which would be below 2,800, or neither occurs before the end of the year. Here are the results. Just over half of you said first thing that's going to happen is the S&P getting to new highs above 3,400. About 27% of you said neither of those is going to occur. 22% of you said we break below the March low of 2,800. It's so funny because we've asked a version of that question pretty regularly over the last 6 months. And it's interesting to see how things have pivoted. You know, about half of you thinking, we retest the highs, break above 3,400. That's not that far off. That's 200 points away from where we're at now. It's about 250 given the distribution we had going into the closing bell today, but it's not that far off. I mean, that's less than the 10% move to get to the previous to the all-time highs there. So it'd be interesting to see how we would get from here to there given the conditions that we're in. And I think as we've talked about last week, you have this balance between stocks continuing to be in uptrends, and it's not all stocks. Don't get me wrong; plenty of stocks are more corrective. We're going to look at some of those charts a little later in our looking at shifting stocks. But on the macro level, you have big technology names that have been driving higher. It's a relatively narrow group of leadership names, but they're mega cap names that are causing the market to go higher. But you're balancing it against headline risk and news risk. And I think the news flow you saw today out of California is a perfect example of what's going to happen. Even though the trend is your friend, absolutely. Even though the trend remains positive, I would say that is true. That's not a judgment call. That's by definition higher highs and higher lows. The uptrend is still in place. But having said that, there's the potential of downside risk of a news event coming in. So it's a really important time now when the market has appreciated so much. Hopefully you've participated in that, to think about the downside risk. Don't think about a news headline and what you would do, but think about the charts and what levels, what signals would cause you to revisit your thesis, revisit your positioning, and line that up now before we dramatically go lower than we are today. Today was not the end of the world though, but it certainly was distribution. Let's look at how things played out. So the S&P finished just above 3150, closing around 3155. That ended up being down about 1%. At one point today, it was above 3230. So most of that just came in the last 2 hours or so. The NASDAQ led the way lower. So the NASDAQ 100 was down over 2% to 10,602. So technology was the weakest. Technology communication services were the weakest, sort of digesting the closing prices here. They're sort of neck and neck at the bottom of the XLK and the XLC, but both certainly distributing to the downside. On the upside, you had healthcare leading the way higher, industrials, financials. So 3 S&P sectors actually up on the day, a couple of them flat, utilities and materials, the rest leading the way down, and tech, communication services, consumer discretionary, 4 of the bottom 11 today. In terms of other asset classes, the TLT, the bond ETF, actually finished in the positive. It was negative at the open, and it certainly felt like a risk on day like we have seen many days up until now. That sort of reversed as bonds appreciated, stocks sold off, and so the TLT finished up about 1/3%. The dollar sort of flat to down, but not dramatically lower. Looking at commodities just very briefly, oil was down pretty significantly in the afternoon. Gold actually was up pretty well with the GLD above 170, and actually came down to close around 169.40. So up a little bit, but it gave up most of those gains going into the afternoon. Sort of focus on the trends here. So what's interesting is earlier in the day, as I'm preparing for the show, I'm thinking about this last line in the sand. The last line of defense here was the June high, right from that first week in June. You could see the peak just below around 3240 or so. We kind of came back. We were aiming back to those levels. So over the weekend, as I'm looking at the charts, I'm thinking we've now settled above 3150. We're now aiming to that 3230, 3240 level. I'm interested to see what the market does there. We got a bit of an answer today because we sort of hit that intraday and then came off pretty quickly. We actually closed back right around 3150, which has been resistance for a number of weeks now. And actually, this is really the center of the range that we've seen in the last week and a half here. So we sort of settled right back into that 3150 level. We've now sort of established a bit of a shorter term range between 3120, 3130, and then on the upside 3230, 3240. So we're sort of within this short term range. As we've talked about for a while now, we've established overall a much wider range between the June highs at the top. That first gap down gave us a swing low around 2960 or so, and that's really the range that we've been in. We've tested the lower end of that. We've now tested the upper end of that. That thesis, I think, remains in play. I think you wait to see which way we break. It's been so tempting to believe the market could just go to the moon from here, and it very well could, but until we break above that June high, it's not quite happened yet. Also, on a day like today, where it feels like everything starts going down, let's remember that we have really important support not too far from here, right? So around that 2950, 2960 up to 3000 level, which would be the 200-day moving average, that psychological support around 3000, and the lows from that swing low back at the second week in June. That's sort of the lower end of this range that we might come back to. So I wouldn't be surprised if we make our way down there, and then it's going to be all about how we perform around that range. So don't get me wrong, this was one day among many, but certainly felt some short-term distribution. I think for a lot of investors, what this is going to represent is the headline risk, the downside potential for a headline like we saw today, suggesting the economy does not open as aggressively as we'd want, suggesting this might take a little longer. It's going to affect companies in ways we haven't really priced in yet, and as a result, the market would most likely come down here. So as I mentioned, I think this is a really key time to be paying attention to some key support and support levels and identifying where you might expect some sort of signal. We don't have time for a full sector review today because I wanted to have Rick on the show because his presentation is tomorrow, and I wanted to get his insights while we certainly could. But I did want to just make a couple of quick mentions about some of the sector themes that we've seen. It'll be interesting to get a read on the breadth. I wouldn't be surprised if the breadth rotates lower in a pretty meaningful way. But what we've talked about is the strength in technology, sort of leading the way higher. It might be a little hard to see this on a 2-year chart, which is sort of the main way I look at the sector, but you can see here the chart of the XLK. This is a bearish engulfing pattern that we ended up getting today. Did not look like this earlier. It looked like the XLK going to new highs along with many other stocks. A lot of bearish engulfing patterns are going to emerge when all is said and done today because of opening higher and then closing back lower. And as a reminder, that tends to be short-term resistance. That tends to mean the next couple bars you'd expect more weakness rather than strength. You'd expect a bit of a pullback to digest this, which I think was what the rest of the week most likely will probably mean as we process what happens as probably more headlines come out. So expecting now short-term weakness for the remainder of the week. But I think that chart of the XLK is pretty meaningful. XLV is another one. So this is another sector really testing the previous highs. And as we talked about, you'd want to see sectors like this be able to eclipse the previous highs, eclipse 104 and break above it. Days like today make it feel not as possible as it might have been, right? Where you get up to these levels, you get up to the resistance range where we found resistance previously, we actually come down and now closing more toward the lows. But again, overall on the long term, this is still a pretty long-term base. We still have a pretty key resistance level, and it'll be all about if we can reclaim the momentum and try to revisit those previous highs. That's our market recap for today. We need to take a quick commercial break. We'll be back with my guest, Rick Bensignor. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is your host, Dave Keller, here at StockCharts.com. I want to thank you for joining us every weekday for the final bar. As a reminder, you can get comments, questions, feedback to us 2 ways. The main way via email, thefinalbar@StockCharts.com, or on Twitter, just tag us in the comment at FinalBarSCTV. As a reminder, tomorrow we'll do another mailbag segment. We'd love to answer one of your questions on the air. We've got some great questions as we've all been sort of trying to digest the movements of the market, make sense of things. So questions on the charts, on technical indicators, on decision making, whatever it is, answer away, and we'll do our best to answer your questions on the show. I want to welcome on my guest, Rick Bensignor from In the Know Trader. Rick has a successful show on StockCharts TV of that same name, In the Know Trader. He's actually giving a presentation tomorrow on StockCharts TV at 10 a.m. Eastern, focusing on his second half of the year outlook. So I invited him on the show today to get a quick preview of what he's going to be talking about. Rick, thanks for coming on the show.
Dave, thanks for having me.
So you sent 2 charts, and again, all eyes on the S&P as I think this uptrend felt like it degraded very quickly in the last 2 hours of trading. But what is your perspective, up until today, thinking, looking long-term forward? Tell us where you're at with things.
So this chart, Dave, is something that I've shared with clients, both institutional and our In the Know Trader clients over the last several weeks. And what it represents here is the green downtrend line from all-time highs, what I've labeled line Y, is simply a downtrend line. And this morning, obviously, we gapped above that line, but we've closed beneath it. This is a weekly chart. So 3183 is that value for this week. And I think that's something that we really need to pay attention to, especially now with the chance of maybe a double top against the 32, 33 high that we had in June. What the other uptrend lines that you see here, line X is the exact same angle off of the low that we made off of the high when we made that June high, and it allowed me to draw the downtrend line. So that was a minus 34-degree line. So I actually created a 34-degree line off of the low, just if we were to have a similar type look, and that line X gives you a sense of where that is over time. But I also added a 1.5 times X line and a 2 times X line, essentially saying 51 degrees and 68 degrees off of that bottom because of what I call the Powell put. Not feeling as if we're going to necessarily do the exact same thing off of the highs as we did on the lows, but this pattern is pretty clear. I think left half of a diamond shaped pattern, and the move from all-time highs to the March lows to me is the middle of the pattern, which means it's possible that we could go as long as another year or two before we'd make new highs or take out the March lows, which seems hard to think, and I know I'm not in the consensus in that thinking. But where we stop today and where we have to focus on this week, kind of this 3183 level, I think is really important, because if we do have a sense of a double top now, especially with the news out of California, and they also announced today that public schools in Los Angeles and San Diego will be closed and it'll all be online learning to start the school year. I think the market really took that negatively, along with everything else coming out of California, plus the general news headlines on just how much the coronavirus is still very evident. And I think we've tested as high as we're going to right now. If we take out today's highs, then we probably keep going, and the bull market will continue marching as it has. It doesn't mean it won't pull back at points, but you know, what occurred today, I think, is actually very important in the scheme of things. Now, if we pull back, I've got 2934 down to 2864 in the S&P is where aggressive buyers should be doing the bulk of their buying. Otherwise, you're talking about a move all the way down towards 2650 or beneath later this year. And that could happen if elections don't go as expected. And, you know, you get a whole change in psychology. So we really got to focus on what happened today as a potential meaningful near-term high, and possibly how it leads us to the whole second half.
What I love about this chart, Rick, is it includes not just the price relationship, it also focuses on the time too. And I think so many people think of the markets as sort of a binary outcome. We're either going to go to the moon from here, or we're going to go to the zero. And what you're showing us is, I feel like if you zoom out enough, at some point this is going to resolve one way or another, but it can take quite a bit of time to sort of back and fill and digest what has happened over the last 6 months. Is what I'm
completely, Dave, because the left-hand side took 2 years to develop. Yeah. So that's why I never joined in the conversation of people thinking that we were going to scream to new highs or take out the lows. I think this kind of shows you've got the range in for the balance of the year.
Now, we only have a minute left, but I did want to get to your chart of the dollar, Rick, because we talked about just the weakness in the dollar and how, you know, non-U.S. stocks all of a sudden, you know, really starting to explode, like emerging markets come to mind, and China, for example, really ripping to the upside. What is your take? Where are you at with the dollar, and what should we expect going forward?
So when we look at this chart, you can see the long-term trend is still higher if we connect the early 2018 low to the March low from this year. But you see, we keep playing with a 200-week moving average. We've now done it, 4 or 5 out of the last 6 or 7 weeks. I've identified this kind of general buying zone, or to me, this is the last place that dollar bulls need to see hold. Otherwise, for the first time in several years, the bears will be back in control. So I'm using 95.21, which is a DeMark or propulsion exhaustion level, as saying the level at which, if we get under, the bulls no longer control the US dollar. And that's good for gold if it breaks down. That's certainly good for emerging markets.
That's a great take, Rick, and a good chart. Thanks for being specific on that. Rick Bensignor, thank you so much for coming on the show. And again, your presentation's tomorrow, 10 a.m. on StockCharts TV. We're looking forward very much to getting more of your insights.
Dave, thanks for having me.
That was Rick Bensignor from In the Know Trader. I've known Rick for a number of years, and he was actually my predecessor at Bloomberg. And as always, I didn't get a chance this time to thank him, but I often thank Rick for leaving Bloomberg when he did, because it gave me an opportunity to become him a few years later and help me learn technical analysis and connect with a lot of great people. So I've always been very appreciative at Rick and others paving the way for people like me. I want to get on to our next segment, which is called Shifting Stocks. So normally on a Monday, what we love to do is hit the market from 3 directions: the top-down macro, The sector rotation, so we touched on a bit on healthcare struggling and technology, the bearish engulfing patterns I think that have emerged today. We're not going to talk about shifting stocks, and as I've mentioned many times on the show, over the weekend try to go through the S&P 500 chart by chart, go through the individual names, and just see what sort of patterns come out of there. Because I found a lot of times, you know, your analysis of the broad markets, your analysis of the sectors will give you one level of clarity, but you get so much more by looking at the individual stocks that comprise those indexes, because then you start to pick up on themes. You start to pick on what's working and what isn't. You really start to be able to differentiate within sectors and sort of identify where there are strengths and weaknesses. And especially now, where some of the leadership is relatively narrow, I want to start with consumer discretionary, because that's where I found some of that narrow leadership, right? So we know the chart of Amazon overall has been fairly constructive, and you know, today a lot of these are going to look fairly distributed. Amazon actually closed down 3% with the bearish engulfing pattern, along with many stocks. I think this suggests the rest of this week is going to be a little bit challenging. I'd be surprised if we reclaim the highs that we saw today through the course of the week, just because of the distribution we're seeing today. I could certainly be wrong, but that's sort of what I'm feeling on this. It's coming out of an extreme overbought signal, which tells me that if and when a stock like Amazon pulls back, you'd expect at least one more move higher, because it's been so positive. The momentum's been so positive. It usually doesn't just turn on a dime and that's it. But usually that next high, a lot of times, will be the bearish divergence, where you have higher highs in price. You retest the highs, we have a lower momentum value, and usually that suggests a bit of internal weakness. So along with Amazon, there are other stocks that are actually doing fairly well. And I'm afraid to bring up some of these charts now after today, because I haven't looked at them going into the close. I did this yesterday as I was going through. Domino's Pizza struck me as a stock that was just breaking out on Friday above resistance. So today you have, you're not going to like this, it's called a gravestone doji candle. This is when the open and close are right at the lows of the day. You have a big higher level here. Actually, that's gravestone doji. I'm just messing up my candle patterns here. Long story short, that's actually not positive. That usually suggests short-term weakness, as you can assume by the moniker gravestone doji. But there are other stocks that actually have held up. This is L Brands LB, actually finished positive here. This is up almost 3% today. You know, L Brands is actually interesting. There are charts like this that are testing the 200-day moving average from below. I'd be interested to see, especially given the macro headwinds I think we're going to feel, if stocks like this are able to emerge. But it's approaching resistance essentially from below at the moment. WHR Whirlpool is another one that kind of came through on my process, having just broken above the 200-day moving average. The last time this happened in June, that was sort of it. It sort of pulled back and went down below the 200-day moving average. So on something like this, is it able to hold that level of support around 130.60 if and when it pulls back a little bit? My concern, though, is even though you have constructive charts like that, you have charts like Starbucks, which have failed at their 200-day and continue to make lower highs and lower lows. The relative strength has been abysmal. So within something like consumer discretionary, pretty diverse sector, you have sort of the haves and the have-nots. And I'd be certainly, that's not the right ticker, eBay is what I was going to bring up. I think what you have to be wary of, or what you have to look for, especially given what we saw today, you have a number of stocks like Amazon, like eBay, that are extremely overbought with an RSI above 80. More often than not, that means a brief pullback, at least one more push higher. And I'd be interested to see if that actually plays out here, and if you're able to get some sort of secondary peak. Yeah, Tractor Supply was another one. You can see the bearish engulfing pattern here coming out of an extremely overbought range. It's just closed with an RSI below 70. So certainly across the board within consumer and a lot of sectors, you're going to get some short-term weakness sort of signals. I did want to hit within communication services. Charter is actually, that's not it, CHTR. Sorry, I said the sector and typed the sector ticker and typed the wrong ticker. CHTR. You know, Charter Communications is one of those charts I've been keeping my eye on for a while. I like the 180, the round trip from the peak to come back to retest the highs. The shallower pullback, we're now testing that right side of it. And again, until you get a break above resistance, it's not quite a signal yet. And I think you'd want to see this above 550. Has not happened yet. It's on the radar for, you know, breakout potential, but it hasn't happened. But I think you want to keep an eye on it. Comcast is another one that's actually testing its 200-day from below, similar to some other charts that we've looked at here. Again, you'd want to see a break above the 200-day. We haven't quite haven't quite had it yet. Dish is one here that is a little more concerning to me because it broke above the 200-day moving average. Look at the bearish divergence you had here with higher highs but lower peaks in the RSI. Now a lower high, now a lower low, breaking back below the 200-day moving average. So that feels a little heavier to me looking at Dish Network. I'm going to jump around randomly to charts that looked good to me on my review, and now I'm very curious what they look at here. So JB Hunt is actually a really interesting one. It came on the radar because it had that base, it tested the resistance, it broke out. This is about a week ago, and so I was looking at it last week. Interesting chart. What's happened now is you have the bearish divergence, higher highs in price over the last 6 weeks, lower peaks in the RSI. I wasn't quite ready to say that that was, you know, a peak in the RSI. I think today's sell-off, not quite a bearish engulfing pattern, but really close, certainly distributive, suggesting short-term weakness, which means this is most likely going to look like a bearish divergence, which is most likely going to suggest some short-term weakness there. So I'm a little wary of that. Within technology, we talked about the XLK. I think semiconductors are one place we're going to see a lot of divergences. This concerns me because the strength in semiconductors is one of the bullet points in a bearish thesis. That continued strength in some of those key stocks, potentially starting to taper off a little. Again, the bearish divergence with lower peaks, higher price, lower RSI. The bearish divergence or bearish engulfing pattern with engulfing Friday's close, suggesting short-term distribution. So again, I'm getting a lot of signals suggesting short-term weaker rather than stronger. Can I find one chart that actually has held up pretty well? Maybe we'll give you General Mills to finish it off here. Again, this is sort of a shooting star pattern, a negative candle pattern today, as you're going to find pretty much across the board. But just testing the previous highs and making a new closing high over the last day or two. So we'll see if that remains above. With all of these stocks, as I'm seeing these divergences and seeing these short-term patterns, I'd be eyeing on a stock like General Mills 59. As long as it remains above there, this congestion range is still fine and it's holding up. If and when we would break those levels, which is a long way away from where we're at today, that's where I would be concerned. But overall, this suggests short-term weakness within an uptrend for a lot of stocks at this point. That's our shifting stocks. And speaking of shifting, a lot of these shifted a great deal going into the close. I'll enjoy going through a lot of these in a little more detail and through the rest of the week, starting to tease out some of these themes and whether these levels are able to hold. But again, short-term feeling weaker rather than stronger. Let's wrap up the show, folks, and go right to the 3-and-3 charts in 3 minutes. Here we go. We're going to start with a chart of the semiconductors index. We just finished there. And I just wanted to point out the fact that, again, we've talked about the bearish divergences in a lot of technology. We have not had a catalyst to push lower. I don't know if the news flow today and the sell-off we saw today is the beginning of something deeper. I do know right about now is the time to be thinking about risk management, thinking about trend lines that might break, thinking about potential signals that would cause you to get out of a stock, and just identifying where those are. And then don't worry about it. You don't have to worry about it. You plan for it, and then trade your plan as you go forward. But I'm certainly, have seen some warning signs about overextension, and I think today we're getting short-term distribution signs that might cause those to become more and more clear. Chart number 2 is communication services. Again, some distribution, but this is a sector that, as I was going on Friday, going into today's show, I'm looking at the fact that on Friday it actually made a new closing high. It finally broke above the high from February, which it had been teasing for a little while, which feels very positive. Overall, that still might end up working out to be very positive. But for today, again, it's short-term weaker, suggesting some short-term weakness. But on a pullback, you want to make sure you have a higher low, and that's it. Healthcare is our last chart for the 3-and-3. On a relative basis, healthcare has just been so difficult. But within healthcare, you actually have a pretty diverse group of stocks. So think about biotechs relative to pharma, relative to supplies, and other groups within there. This still is setting up as a pretty decent base. And as long as we hold the 200-day moving average on a chart like this, hold at the previous lows around 100, that would be the first short-term support I'd be looking at. Overall, the trend is fine, but until you're able to break above there, I still see the upside as being relatively limited. Folks, that is our show for today. Thank you so much for joining us. Technology a little bit different today. I actually have the family up in the San Juan Islands, up in the Puget Sound area. It's a beautiful place to try and recharge and get away from everything, which I'm trying to do when I'm not doing the show for all of you. But thanks for sticking with us as we get things going. Charting the second half this entire week, so check out our schedule on StockCharts TV for a lot of fantastic outlooks for the remainder of the week. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.